Hi everyone, and thank you for tuning into my channel where I post videos about stocks, the stock market, and investing. I post videos daily, so if this is something you want to get more of, please subscribe down below. In today's video, I'm going to be talking about if Lowe's stock is a buy, and I'm going to be using my simple 6-step framework for analysis. So let's get right into it. The first step in my framework is the customer value proposition. So Lowe's sells home improvement necessities at low prices in large stores nationwide. It aims to have the goods that you need in stock somewhere close by so that you look to it when you have some project that you need to complete in your home. If you accidentally flush something down the toilet that backs it up and you need to go get that fixed and you need a plunger, you're going to need that item in a hurry. You're not going to want to go to Amazon and wait 2 days to receive that item to fix your toilet. You're going to need that item in a hurry. So that's where Lowe's tries to provide the greatest value in that having the items you need somewhere close by at reasonable or low prices. And in that regard, it's done a pretty good job. Revenue has increased from 50.5 billion in 2013 to 96.3 billion in 2022. So customers are voting with their dollars and they're saying that Lowe's is doing a good job. The next step in my framework is the unit economics. So Lowe's is a brick and mortar retailer, or in other words, it's a merchandiser. And are merchandisers survive based on their ability to buy low and sell high. They got to buy inventory at lower prices than they sell them to customers for. And in that regard, Lowe's is clearly doing solid. It has shown economies of scale. Operating profit margin has increased from 7% in 2013 to 12.6% in 2022. So revenue is rising and profit margins are rising. Two solid trends that you like to see as an investor. The next step in my framework is the total addressable market. Large total addressable markets have a solid impact, have a solid outcome or solid effects in the companies in the industry. If there's lots of customers and lots of customer spending circulating, there's less competition. There's fewer need for competition because there's so much business to be had. So the home improvement industry is massive, estimated to be worth 900 billion. Competition is I would say, one of the more important steps in my framework, and Home Depot is its biggest competitor. But between the two of them, there's limited competitive activity. What I mean by that is you're not seeing the two of them directly compete with each other, trying to undercut each other with prices. And when that starts to happen, if Home Depot lowers its price by $1, then Home Depot can lower its price for $1 on a similar product, and then Lowe's will go lower and lower and lower. And in this way, prices move lower for the retailers. Customers benefit, yes, but margins are falling because they keep competing with each other at lower prices. So the absence of this type of price cutting is good news for investors. And Lowe's, along with Home Depot, are a few of only a handful of brick and mortar retailers that have protected themselves from Amazon. And it's because of what I mentioned earlier. The types of products that they sell make it difficult for Amazon to compete. And as fast as Amazon has gotten in delivering items to your home, they're yet to be as fast as driving to your local store and picking up the item immediately. So because Lowe's sells a lot of the products that when you need it now, that's helped protect it to some degree. And additionally, because they sell so many big and heavy, bulky items that are difficult to ship to your home, that's been another factor that's protected it from Amazon encroaching on its business. Valuation is the next factor in my framework, and looking at Lowe's, the stock is relatively inexpensive, and I use the price to earnings ratio to measure this. If you look at its price to earnings ratio of 15.3, it's just about as low as it's been dating back all the way to 2018. You've only had a few opportunities to buy Lowe's stock at a lower price than you have the opportunity to buy it today. So relatively inexpensive when looking at its own historical price to earnings ratio. Finally, risks are the final step in my 6-step framework. And one of the risks facing Lowe's is the homeowner's willingness to spend on their homes because of the change in home values. So what happens with homeowners, and Lowe's management talks about this all the time, is that when home values are rising, people feel that when they spend on their home, they feel like it's an investment because the home values are rising. Now, when their home values are falling, people feel like when they need to spend on their home, now they look at it as an expense. Like, oh man, I gotta go fix this thing again, or I gotta upgrade this thing again, and it's gonna cost me an arm and a leg, or however much they feel that the expense is. They don't feel like they're investing. They feel like it's an expense. And so that risk has risen recently because home values have soared in the last 2 years, but starting a few months ago, home price growth has slowed and is actually falling in some cities across the US. So if this trend continues, it could be a risk for Lowe's. Another risk is that consumers might be feeling home improvement fatigue. And I mentioned this with Home Depot as well. The two retailers got a huge boost from the pandemic as competitors and other industries were forced to close their stores. Consumers had fewer options on what to do with their time and money. They were spending so much time at home. So, home improvement projects were one of the most popular things they did. And so they painted every room, maybe they changed their doors, maybe they upgraded their kitchen. And so now that economies are reopening and people are more interested in spending money on away from home experiences, that could take away money that was set aside for home improvement projects. The third risk is the potential for an economic recession in the US. As you might imagine, if individuals and families are experiencing job loss or pay cuts, they're going to be less interested in taking on home improvement projects. If they were planning on upgrading their kitchen, or if they were planning on replacing their fridge with a new stainless steel fridge, they're going to delay that project if they feel like they're at risk of losing their job or if they just got a pay cut. And so the risk of economic recession is rising in the US. You could argue that we are in a recession because GDP was negative for the previous 2 quarters, and that's typically one measurement that the BLS uses when they determine if we're in a recession or not. So, because of that factor, people could be delaying these home improvement projects, and that's a risk for Lowe's and Home Depot for that regard. Okay, so now that we've looked at all 6 factors, let's review them and let's review the score that Lowe's received in each factor. For the customer value proposition, I gave Lowe's a good score. The customer value proposition is not excellent. It's good. It's solid. It's not excellent. Um, Lowe's unit economics are excellent. It's able to buy goods at lower prices and sell them at higher prices, and it sustains a solid gross profit margin, and it's experiencing a rising operating profit margin. So I like their unit economics. They get an excellent score from me. Total addressable market, again, they get an excellent score from me. $900 billion is a massive market size, and certainly suitable for large players to keep growing in that industry without hitting a ceiling. The competitive position in the industry is also excellent. We're not seeing Lowe's and Home Depot fiercely compete with each other, trying to steal customers away from each other by lowering prices and offering promotions. When I looked at valuations, I noticed that Lowe's is inexpensive when measured by the price to earnings ratio, arguably as cheap as it's been in the last 5 years, going back to 2018. We looked at the risks, and even though they did have risks, those risks were moderate. Overall, when considering all of my 6 factors and the scores Lowe's received, I would say Lowe's stock is a buy. The inexpensive valuation, the massive total addressable market, and the solid competitive position in the industry and the protection it has against Amazon makes me feel good about investing in Lowe's. So I would say Lowe's stock is a buy, but let me know what you think. Comment down below, let me know what you think about Lowe's stock. And if you like this video and you want to see more of videos like this, subscribe to my channel. And thank you for watching, and I'll see you again next time.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.